Today we are going to work on a chapter 5 problem. The chapter 5 is the chapter name is cost volume profit analysis, and for this I have selected this question from the end of the chapter problems, and we're going to calculate the break-even sales and sales to earn a target profit, and then we will prepare a contribution margin income statement. So let's talk about the problem first. England Production performs London shows. The average show sell 1,300 tickets at $60 per ticket. So we know how many number of tickets, and at per ticket charge that they get. There are 175 shows per year. No additional shows can be held as the theater is also used by another production companies. The average show has a cost of 65. Each earning an average of $340 per show. The cost is paid after each show. The other variable cost is the program printing cost for $8 per guest, annual fixed cost of $728,000. The first thing we have to compute the revenue and variable cost for each show. And so what we're going to do is we're going to calculate the sales revenue. So the revenue or sales revenue is the same thing. So revenue is going to be how many tickets we are selling. We are selling on average 1,300 tickets. And we are selling each ticket at $60. So we can multiply this by $60. And so for per show is equal to, there's the calculator. So 1,300 multiplied by 60 is equal to 78,000. So this $78,000 revenue we are making per show. For every show we have a revenue of $78,000. All right, now we have to calculate the variable cost, and for variable cost I'm just going to use VC, variable cost per unit. So this is revenue per show, and now we're going to calculate variable cost per unit or per show, because our unit is a show here. So per show. So the variable cost is the cost of performance, and then we have a total. So the cost of performers divided by cost of program. So cost of performers divided by cost of program. So we have, sorry, I'm saying divided. I meant to say it's a addition sign. So what the cost of performers are, we have the average show has a cost of 65, and each earning an average of $340. So the cost of performers, if we just put them in a bracket, two brackets. So we have 65. The cost of the 65 people multiplied by $340, that's 1, plus we have a cost of program which is $8 per guest, and how many guests we are having? 1,300. So we have 1,300 multiplied by 8. So this is the cost we are paying to the cost member, and this is a cost we are paying for printing whatever pieces, whatever things that we have to print. So 65 into 340, that's 22,100, plus 1,300 multiplied by 8 is 10,400. So that's give us 22,100 plus 10,400 is equal to 32,500. So that is our variable cost per show. Okay, so that is our requirement: revenue per show and variable cost per show. So we have calculated. So this is our first requirement for. Now it says use the equation approach to compute the number of shows England production must perform each year to break even. Break even means no profit, no loss. All right. So what is the equation that we are familiar with is net sales revenue minus variable cost minus fixed cost equals total profit. So that's one way of writing it, or another way you can see that net sales revenue minus variable cost minus fixed cost equals total profit. So whichever way you want to write this down. So the net sales revenue that we have, we calculated $78,000 that we have calculated. So $78,000 minus variable cost per show we have calculated is 32,500, and the fixed cost is given to us is 728,000. So 728,000, which is equal to 0 when a total profit is equal to 0. Now we have to make sure how many shows we have to produce. So this variable cost will have a variable here. So a variable here that will be like, say, an X. So that will give us the number of shows, how many shows we have to perform. So this variable is called number of shows or number of performers. So number of shows and number of performers. All right. So let's move to the second page. So now we have $78,000 multiply minus, sorry, and I think I should have said here the same thing because this is also a number of shows here. So this X will be here as well, number of shows. So 78,000 multiplied by X minus 32,000 multiplied by X minus 728,000 equals to 0. So when we solve this way, so we had 78,000 into X minus 32,000 into X, and we take this on the other side, so it's 728,000, and then we take the X common here, and that is give us 78,000 minus 32,000 is equal to 728,000. So X 78,000 minus 32,000 I'm sorry, that's it's 500. I messed up. This number is 70. You see 72,500. I put it over here, but I haven't carry over. We messed up. So 78,000 minus 32,500. That gives us 45,500, and we have 728,000. So X is equal to 728,000 divided by 45,500. So X should be equals to 728,000 divided by 45,500. That gives us 16 shows. So that means X is equal to number of shows. So we have to do 16 shows in order to have a break-even point, which means, if we do less than 16 shows, that is 15 or lower, we will have a loss. And if we do more than 16 shows, we will have profit. So that's the idea behind this question. So I hope that I was clear on this. So this is one way of writing equation. This way we can do this, and there is another way of writing the equation. Okay. Now the third one, it says use the contribution margin ratio approach to compute the number of shows needed each year to earn a profit of 5,687,000. Round the contribution ratio to 2 decimal places. Is this profit goal realistic? Give your reasoning. So now they have given us a target profit of 5,687,500. So the total profit was given 0 here in this scenario. Now it is not 0. Indeed, it is 5,687,500. So we're going to use, so what is the contribution margin? So we'll take the next, for number 3, we're going to take the contribution margin approach. So the contribution margin, let's say, so we have sales revenue minus variable cost, it gives us contribution margin. And from contribution margin minus fixed cost is give us the basically the target profit. We can get to this. So that's the formula. We have already familiar with it. So what we need to do is contribution margin is equal to, but they are not talking about contribution margin, they're talking about contribution margin ratio. So the contribution margin ratio is equal to contribution margin, which is divided by sales revenue. And what is the contribution margin? Contribution margin is sales minus variable cost. So that is sales minus variable cost divided by sales revenue. Or the sales and sales revenue are the same thing. There is no difference. So if you confuse, you make sure you know it's the sales revenue or sales is the same thing. So how much sales revenue do we have per, so we already know, we have calculated it was $78,000 minus the variable cost we have calculated is 32,500 and divided by the sales revenue of 78,000. So 78,000 minus 32,500 and 78,000 minus 32,500. It's 45,500 divided by 78,000. So my contribution margin is 58.33%. Another way of looking at it, sales revenue is 100%. Contribution margin is 58.33%. So how much would be my variable cost? It will be subtracted by 100. So my contribution margin, my variable cost is 41.66%. So if ever want to see this, this is how you got to this. Okay. And this is our contribution margin ratio. And then see how we're going to use this number. So we are familiar with another formula. It's called required sales in dollars which is equal to fixed cost plus target profit divided by contribution margin ratio. So fixed cost, we already familiar with it. The fixed cost is given to us 728,000 plus, and we have been given a profit of 5 million, target profit of 5,687,500, and our contribution margin is 58.33%. So I'll take you to this next page. So that gives us a total of 728,000 plus 5,687,500, 6,415,500 divided by 58.33%. When we divide this with 0.5833, that will give us $10,998,628.43. All right. Now the next thing we have to calculate. So basically, if we have to need a profit, target profit of $5,687,000, our sales should be this much. Required sales in dollar should be. So if we make a sales revenue of almost $11 million, then we can have 5,687,500 target profit. All right, so now we're going to see required sales in units. So what is our unit? Our unit is number of shows. So basically we are calculating how many shows we are how many shows we have to do in order to make this much sale or this much profit. So the first thing we need a required sales in dollars. That's the number, required sales in dollar, divided by sales price per show, sales price per show. So we have a 10,998,628.43, and the sales price we have already know that we have is $60 per we have calculated sales revenue per show is $78,000. So we're going to sales price per show is $78,000. So when we divide this number, we get 141 shows. So 141 shows. Now the question they are asking, is this profit goal realistic? Give your reasoning. So what do you think? So we have already told that we are selling 1,300 tickets, $60 per ticket, and there are 175 shows per year. So no additional shows. So we cannot go beyond 175, but we can have less than 175 shows. So this is only 141 shows. That means it is a very realistic number. Realistic number because we have a capacity of doing 175 shows. Yes, so we can do this much show, and yes, we can achieve a sale of 10 million, almost $11 million, and we can have a target profit of 5,687,500. Okay. Now, what they are asking to do in number 4 for you is asking you to prepare England Productions contribution margin income statement for 175 shows performed in the year. Report only 2 categories of cost, variable and fixed. All right. So we know that our show is, so sales revenue. Okay, so I'm going to write this thing down. Income statement, contribution, margin, income statement, and then we have sales revenue. So we are doing it for 175 shows. We know that each show is giving us $78,000. We have calculated. So 175 multiplied by $78,000 and minus the variable cost per show is given to us. Oh, sorry, we have calculated 32,500 and 175 multiplied by 32,500. That will give us a contribution margin, and from here we can subtract the fixed cost, which we have given to us 128,000, and that will give us a target profit or operating income, because we are calculating the income statement, so we're going to call this an operating income here. So So 175 multiplied by 78,000, 175 multiplied by 78,000 gives us 13,650,000, and that's our sales revenue. And then our variable cost will be 175 multiplied by 32,500. That turns out to be 5,687,500. And when we subtract these number, we subtract 13,650,000. That gives us 7,962,500. And we subtract our fixed cost of 728,000. That gives us 7,234,500. So that will be our operating income after taking off all the variable costs and all the fixed costs of 7,234,500. So these are the 4 questions that was part of this problem for chapter 5. Thank you very much for watching. If you have any questions, please feel free to send me an email. Thank you.